Are you confused about the difference between infinite banking and velocity banking? Which one's better or which one's worse? That's what we're gonna talk about right now. All right, so I have so many people ask me about infinite banking, of course, but they'll also ask me about velocity banking, sometimes interchanging the two. But guys, they are not the same strategy. In fact, one of them can be very, very dangerous, especially when things turn in the market. And that's what I want to go into today, because if you're not careful, this could cost you hundreds of thousands of dollars, if not millions, if you're not careful with this strategy. All right, so let's talk about what each of these are. Let's start with infinite banking, right? Infinite banking, IBC, the infinite banking concept, is this concept developed by Nelson Nash. Now, he wasn't the one that originally did the strategy. It's been used by bankers and wealthy people for many years, really decades, if not centuries. They've been doing this kind of thing. Heck, even Walt Disney was using this strategy for himself when he was trying to get Disneyland off the ground. So this is something that predates even Nelson Nash. But I do credit the Nelson Nash Institute for really making this more popular, because as the years have gone on, more and more people are looking at using infinite banking. Now, it's not your own bank. This is actually using a whole life insurance policy, which, yes, it does have a death benefit, but it also has a tax-free high yield savings account inside of it. And so when you use that cash, you can actually use it for other things. It doesn't have to be locked up till your retirement, till 59 and a half. It doesn't have to be, something that's just part of your death benefit. It's actually cash you can access and use today. It's money you can actually use, and you can use it for a variety of things. People use it for tax-free retirement. Some people use it for college savings accounts. Other people, like Walt Disney, use it as collateral so you can get more money from the banks and from ABC. You get all kinds of reasons why people will use this. But ultimately, infinite banking is about how to get your money to work harder for you, right? How do you get your money working two places at once, where you can use that money even to invest in different things, and then you make money inside the policy while also making money with the investments at the same time. Now, the infinite banking concept, there's a lot of different strategies, a lot of different ways that people teach it, but that's ultimately what it comes down to. It's using a whole life insurance policy. But that's different than velocity banking. See, velocity banking, when that came out, at first I remember hearing it back in the last recession, the global financial crisis. People started talking about this Australian, I'm not the best Australian accent person, but this Australian type of mortgage or home equity line of credit that people would use, that then they would use it to pay it down, and then they could charge it back up. And then they pay it down, charge it back up. And they could actually pull money out of it. So someone would actually use them to pay bills. Kind of like what some infinite bankers talk about, which I do not agree with 100%. Do not use that to pay bills necessarily. Well, that's what people would do. They would throw all their income into this home equity line of credit to pay the balance down, which means you get charged less in interest because the balance is less that you get charged interest on. And then they would pay their bills with it, charge it up, but then pay it down with the next paycheck. Now, here's the thing. It's like now in America, they said, this is a great strategy. We can pay off our house faster. And there's even some people that say, well, you can use this to go and invest and then use the investment cash flow to pay down faster, which is also a strategy I use when I talk about infinite banking. Using that to pay for the investments, use that to pay the line of credit with the insurance company down to save on the interest and make it money at the same time. Kind of a similar strategy. However, there's a big if when it comes on with velocity banking. Although it looks great in a calculator, real life teaches us otherwise. Because for example, when I first heard about this velocity banking strategy, this was right during the global financial crisis. If you recall, if you're around then, what happens, we had a lot of banks, not just go under stress, right? There was banks that literally could not meet obligations. There was people foreclosing left and right, people that weren't able to pay their loans and this and that. And so as a result, these banks were under stress. And what did they do with lines of credit? They shrunk them. They shrunk them down. So I'll give you an example. I had a client that she had an $84,000 home equity line of credit. Now, she had run it up to about $41,000, and she was even talking to us. She said, you know what, I think my next big investment is to invest in my education for my business. She wanted to become a naturopath. Well, there was a $6,000 certification program that she could get into to become a naturopath. So she was going to take the $6,000 from her line of credit. But guess what happened in the meantime? Without warning, that bank sent her a letter saying, last week, not effective today or on this day, they said, last week, we cut your line of credit from $84,000 down to $42,000. Remember, she already had $41,000 in there. She thought she had more than enough money to use, but they cut the line of credit down to $42,000. This did two things. One, she wasn't able to find the cash to be able to pay for that program that could help her make more money. But two, this also hurt her credit score, because what happens now is it made it look like she was maxing out her line of credit. So her credit score dropped because of this. I mean, nothing changed. She wasn't any worse health-wise, or financial health-wise, that is. However, because it made it look like she's maxing out her line of credit, her credit score dropped, making it harder for her, once again, to get more cash when she wanted more cash. Now, someone might argue like, well, why do you need this anyways? Well, good argument. I mean, you may not need to get that extra cash. It's always based on what you can do with the money. I'm an investor. I know I can use that cash. So the problem is, if you have a home equity line of credit, let's just say you start to pay it down with all that money you're making from those investments and whatnot, and you're paying down that line of credit, you're feeling happy. Maybe you got 150, 200,000 of equity in that home equity line of credit you could use again. And maybe you get to that point, but then all of a sudden, without warning, the bank says, bam, we're gonna now cut your line of credit down so you can't get back to that $150,000 to $200,000. So now that all that money you just dumped in is locked up in your home equity. The only way to get to it is to sell off your home. Now I'll tell you from personal experience, during that same financial crisis, because they locked up equity, because they were trying to cut back lines of credit, it made it harder for people to qualify for bank loans. As a result, real estate values also dropped. So here's the warning, is that if the banks start to do that again, if there's another recession or anything like that again, not only do they cut back your line of credit, but that also could mean that your value of your home goes down. So all that money you threw in cash is gone. This happened to me personally because I had done the same thing. Now I didn't have a home equity line of credit. I just figured at any time if I needed the money, I can always get a home equity line of credit later. So I had paid down money where I had $150,000 of equity in my house. Well, when the recession hit and the banks got tighter, one, they wouldn't let me get to that money anyways, but because of that, and not just me, but because of everybody else, I watched the values go for where I had $150,000 of equity to then all of a sudden they had to foreclose on me later and sold it for $342,000, about really $400,000 less than it appraised for just a few years earlier. $400,000 less, guys. They like cut in half of the value or what they end up foreclosing on. Now the value was already around $500,000 by that point, so I was upside down a little bit. But the problem was this, is that the bank, which was owned by Lehman Brothers, refused to let us short sell the property, meaning sell it for less than I owed on it. They would not let us do it. So as a result, we ended up foreclosing on it, which was $170,000 less than the offers we had on that property. Right there, guys, that is the issue I have with banks and doing this strategy of velocity banking. You never know what the bank's gonna do. In theory, it looks great, but in reality, the banks can change the rules on you and that can stress you out. So I do not recommend doing that. If I'm gonna use a home equity line of credit, here's what I've told clients to do. Pull out that money, use it to invest, make sure that whatever you're investing in is a safer investment, backed by real estate or wherever it might be. And then two, that the cash flow from those investments can more than pay your payment on that loan. In the case of Velocity Banking or home equity line of credit, it's interest only. So if that can at least pay your payment and then some and have some profit, that could make sense. Lately, because interest rates have been higher, I've really been shying people away from that strategy. Not just running it up, but I actually encourage people to not pay it down, to keep it run up higher. If you keep it up higher, they can't cut back the line of credit on you, right? So if you just pay interest only, or maybe a little bit more than interest only, so there's just a little bit of pay down, maybe a couple dollars a month or something like that, great, do that. That's a safer strategy if you're gonna do this velocity banking and then pocket the rest of the cash to then use to invest out of pocket. That is a better way to use velocity banking. And this is also why I use infinite banking instead. Just so you know, a couple years ago, I actually had a company that their one and only strategy, this company was like a one-trick pony. They only could rely on doing this velocity banking strategy to help them be able to save and invest and then pay down their mortgage and everything else, and people thought it was amazing. But then when interest rates went higher, they're panicking because now their strategy was no longer working. On top of that, they reached out to me and they said, hey, we hear about this infinite banking thing. Should we use that instead? And so even the people that have been teaching and selling people on velocity banking are now going back saying, maybe that's not the best strategy in every market. You're right, in low interest rates, it works great. When rates go higher, not so much. But the one thing that's always consistent throughout any market is infinite banking. That is the one strategy that always works. Now, like I said, it's not that I don't use home equity line of credit. Heck, in 2020, I got a home equity line of credit and I pulled it all out because I wasn't sure what the banks were gonna do. I wasn't sure if they're gonna go under. So I wanted to make sure I got as much cash of equity out of my home as I could while I could, and then I went and bought more real estate properties with it. That's the kind of thing that I would do. Now, right now, interest rates have lowered a little bit thanks to the Feds lowering about 1% in the last few months. That helps. It could make sense, but again, you gotta be very, very careful when you use it. And if you're gonna do the velocity banking strategy, do not use it as a method to pay off your house. Honestly, your best method for paying off the house is to pay a 30-year fixed mortgage. Don't go with the higher interest home equity line of credit that they sell you on. Do the 30-year mortgage, pay it like normal, But anything extra, rather than paying extra to your house, which is what I made the mistake of doing before the last recession, instead, pocket that money. Maybe you do store it inside Infinite Banking Policy to make tax-free returns on money. Maybe use that money instead to go and invest and buy more homes. So then at some point you can sell those homes and then use the equity and the proceeds from that to pay off your house. That might be a better strategy instead of doing this velocity banking where it's very, very market dependent. So of course, these strategies can always vary. It depends on situations, case by case. I'm not trying to give you advice of which one to do. I'll just tell you, I consistently use infinite banking all the time, where velocity banking is very much market dependent on interest rates. And it's very situational and it's very dependent on how good of a steward you are with your money. If you're a spender, don't ever do that strategy, right? If you're an old penny pinching saver, it might work for you. Now, if you have more questions, what can you do? How can I get a better infinite banking policy that actually can work better than the typical ones you see out there? Go click on this link below and we'll be able to help you schedule a meeting with us today.